the political economy of ignorance and error correction that we start to derive from the financial crisis in the book starts with that point. It seems that bankers were, in the aggregate, were ignorant, just like everybody else, or almost everybody else, of what was about to happen in the housing market. On the other hand, so were the regulators. Not only were the macroeconomic regulators like Bernanke and Greenspan ignorant of the fact that it was a housing bubble, but the microeconomic regulators, the Basel regulators, and the Fed, the FDIC, the controller of the currency, and the Office of Thrift Supervision, which issued the recourse rule in 2001. Back then, arguably, there wasn't a housing bubble or boom yet, but it didn't seem to occur to them that these regulations, by penalizing banks that made business loans compared to mortgage loans, by requiring twice as much capital for such loans, and penalize banks that made business loans rather than buying AAA or AA mortgage-backed bonds or agency bonds, by requiring 5 times as much capital for a business loan, that the regulations themselves could contribute to a housing bubble, or alternatively, and the two aren't mutually exclusive, that the regulations might concentrate housing risk in banks, that if there were, for some reason, a housing bubble, could cause a financial crisis. We also have other arguments in the book. There's a whole chapter about mark-to-market accounting and the interaction between mark-to-market accounting and capital adequacy regulations, where it appears that the Financial Accounting Standards Board either was ignorant or didn't think through the consequences of mark-to-market accounting on writing down banks' capital to a level that conforms with market opinion about a bank's assets at a given time, which is certainly not infallible opinion. Panics can and do happen. That's what we think happened in this case. There was a panic about the value of AAA mortgage-backed bonds, but that reduced by law the value attributed to the bank's capital, which meant a gigantic reduction in banks' lending capacity, which we argue may have contributed to the Great Recession, and therefore translated a financial crisis into a real economy crisis. So we have ignorant bankers and we have ignorant regulators. That's a good place to start as a microcosm of a political economy of ignorance and error. But it's not exactly a draw, because when regulators make a mistake, it's imposed on the entire society, in this case on the entire banking sector of the United States, and through the Basel Accords on possibly, depending on when Basel II went into effect in different countries, possibly on the entire world, almost the entire world's banking system. So regulations tend to homogenize, in this case, banks' risk-taking practices. I mean, that's the whole point of regulations. In this case, in any case, to make a society conform to what the regulators feel is a better society. I'm not saying feel like they wake up and arbitrarily get this feeling. One of the most important points of the book is that all of these regulations followed logically from the premise that deposit insurance had created moral hazard. So we're not saying that the regulators were in any way arbitrary or irrational. That's what makes it scary. They were in fact quite logical and rational in imposing these regulations. And yet, it seems that by homogenizing banks' investment practices, that they may have increased systemic risk instead of decreasing systemic risk.